Hey everybody, welcome back to 5 Minute Financial Markets. Well, today was the big FOMC minutes release. I've been saying for the last week or so that that was going to be a bullish development for the market, and I was absolutely right. I have to say though, it wasn't as bullish as I expected it to be. So looking at the 1 minute chart here, this is right where the FOMC minutes came out, 11 a.m. Pacific time, and we got a nice about a 0.5% bounce immediately afterwards. I really thought this was going to be a big breakout move here. You've got this bull pennant developing, big move higher, and then just chopping back and forth in this slightly descending wedge. And right here, about 45 minutes before the market closed, we broke out, and I thought, all right, here we go, straight to 405. And the market had other ideas, which unfortunately it sometimes does, and just sort of U-turned and kept chopping for the rest of the day. Still a decent day. We finished up about 0.2%. I'll take it. I also had some profitable intraday trades, which I'll talk about in a minute, but I really did expect to move up to 405 today. So we'll see what happens on Friday with the shortened trading day after the holiday. Looking at the daily chart, we're still in this ascending channel that I've been talking about. We've got resistance here at 405 with the 200-day moving average, and more resistance here around 408 to 410 as we approach this descending resistance line, which has just been a brick wall every time we've hit it so far this year. Going back to the highs in January, the highs in March, the highs in August, every single time we've hit this downtrend, we've rejected hard off of it. We'll see if that happens again. I certainly expect a lot of resistance here, so I'll be getting relatively flat if we get to that 408, 410 area. So I mentioned the intraday trades I did. I bought some same day calls right down here as the market tagged this green line. I actually bought it slightly above it, so about 399.40 was where I had my entry. And then I closed out most of them here, actually right here at this red line. And then I held the rest of the calls until close to expiration when I realized that we weren't going to 405. I closed out right around here and took the remainder of my profits. So, how did I know to buy at this level? What is this green line? This green line is the high from 2 weeks ago. So, if you look at the chart I actually use when I'm day trading, there's a lot of lines on it. I don't want to put it on the video because it'll be too confusing, but when I'm actually doing my intraday trades, I have the previous week's high and lows, I have the week before's highs and lows, and I have the highs and lows for the last several trading days. I also have this red line, which is the anchored VWAP, the anchored volume weighted average price. So for each session, this takes into account price and volume of every single trade and creates a line that tracks that. It winds up being a good indicator to spot potential pivots throughout the day. I also have the 200-minute moving average and the 5-day moving average, which again are historically very strong resistance and support lines. There are a lot of bullish indicators in the market right now. Looking at the US dollar, we've talked about this before. The first half of November, the dollar has really sold off hard after an incredibly strong 2022. You see it's just been almost a straight line up in 2022. This is the first sign of weakness, and this whole first half of November it's been selling off. Finally found some support here, and it looked like it could go either way, either retrace back up to this 110 level or do a U-turn. It looks like it chose the latter, a big decisive move down today, which again should have been stronger for equities. I'm not sure why that didn't have a bigger impact on the market, but we will definitely find out in the coming days. Looking at the VIX, the volatility index, this is another indicator like the dollar that should have a negative correlation with the markets. You want to see the VIX going down in order for the markets to go up, and go down it has. So after trading this whole year inside this wedge, this contracting wedge, here we had a little breakout in August on the August highs, but then it quickly got back into this wedge. And now for the last week, it's been outside of this wedge and falling hard. We broke through this support level. We are sitting at these two support levels, going back to these two pivot lows, as well as these pivot lows. So this is a big moment for the VIX. I suspect it's going to have a bit of a retrace higher because it's come down so far, so fast. If you look at the RSI on the VIX, which is an indicator of momentum, that's the RSI is Relative Strength Index, it's way down here below 30. That's way oversold territory. I don't remember the VIX ever being that low, and I mean, I'm scrolling back to 2010. I don't see any time where the VIX was that oversold, so it's really, really due for a bounce here. Again, usually a bounce in the VIX is negative for the market, so this is the one indicator I see that does not give a bullish message. But I suspect any bounce in the VIX will be short term, and then markets can resume heading higher. I want to take a look at smart money versus dumb money. We've talked about this in previous videos. On top, we've got the S&P 500. On the bottom, we've got the HYG, which is the high yield bond ETF. So The bond market is the smart money. That's where the smarter traders are, the more informed traders, typically the professional traders. The S&P is the unwashed masses. That's the general public, and they're, by comparison, dumb money. So whenever you see divergences between what the S&P is doing and what the bonds are doing, you really need to pay attention because the bond market is usually right. So back here in November, we had a higher high on the S&P, lower high on the HYG, and the market sold off immediately after. Here in March, we had a higher high on the S&P, lower high on the HYG, and the market sold off. Here in the summer, we had a higher high on the S&P, lower high on the HYG, and the market sold off. So earlier, about a week ago, I talked about this potential divergence forming here. We had a higher high on the S&P, we had an exact double top on the HYG, so not as big a divergence, but something to keep an eye on. But you see today the HYG broke out and formed a higher high, so that divergence has now converged, which is a bullish sign. When the markets are moving in the same direction, it tends to indicate that there's room for more movement in that direction. That's all I have for you guys today. Have a wonderful Thanksgiving, and we'll talk to you on Friday.